From your reading, you're already familiar with the first 4 steps of the accounting cycle, or the analyzing and recording process. We already know that the objective of accounting is to identify, record, and analyze all relevant business transactions. Well, how is that done? Well, here are the first 4 steps of that process. The first is to analyze transactions from some sort of source document. A source document lets you know that a transaction has in fact occurred. Examples of source documents include checks, bills, timesheets, and there are some others listed in your book as well. In these examples, a check lets you know that you're paying someone because you've received either a good or a service in exchange. So there's been an exchange there with the company and an outside party, and therefore it represents a transaction that needs to be recorded. Same thing with a bill. We've received some sort of goods or service, but we have not yet paid, and therefore we have an obligation to pay. Timesheet, that would be from your employees, meaning that they've put in some hours of work and you owe them for their time. So again, there will be an exchange there. Those are all examples of source documents letting you know that a transaction has occurred. You'll go ahead and then record that transaction in what's known as a journal. A journal may also be called a general journal or a book of original entry. Basically what it is just a chronological listing of all of a company's transactions. Chronological just means by date. So it lists every single transaction that a company has engaged into by date. So a company pays its employees, if it buys some office supplies, sells some goods or services, all that's going to get recorded. After recording that information into the company's journal, you will then post the journal information to ledger accounts. Post is just another word for moving or transferring that information. You're in no way going to edit the information. You're just going to move what's already been recorded in the journal into the account ledgers. Well, why would you need to do that? So that you can at any point in time view a single account and know what the ending balance is. If you didn't have ledger accounts, you wouldn't be able to see that ending balance without going through all of a company's chronological transactions and adding and subtracting every time you saw that specific account. So it really is beneficial to the business process. So those account ledgers are going to list all the details that affect that specific account. So you'll have a ledger for every account the company has. Their cash account, accounts receivable, accounts payable, common stock, etc. After that, the 4th step in our recording and analyzing process is to prepare the trial balance. Now this is an internal financial report, so it's not one of those external financial statements we learned about in Chapter 1, which was our income statement, statement of retained earnings, balance sheet, and statement of cash flow. So the trial balance is for internal purposes only. It's going to list all of your account ledger balances at that point in time, and hopefully all of your debits will equal all of your credits, and you will therefore be in balance and then be able to go on to the next step of the accounting cycle, which we'll cover in Chapter 3. So that's just an overview of the first 4 steps that you will be looking into in Chapter 2.